Yeah, the seesaw, the best metaphor for volatility in 2023. Lots of funny videos online that feature seesaws tend to illustrate chaos, and considering the global economic headwinds this year, it does sound like an appropriate description. Vetiva Capital Management has utilized the seesaw metaphor in their outlook for 2023. We're joined by their Sub-Saharan Economist, Ibukun Omoyeni, to look at the Sub-Saharan African section of that report. Ibukun, you're very welcome. Thanks for joining us. I like the use of the metaphor of the seesaw in your report. You say growth in Sub-Saharan Africa could actually deteriorate. Why is that?
Okay, so looking at 2022, for instance, we saw the Russia-Ukraine crisis, and that crisis affected a lot of countries in the region. And what we've seen is that from high inflation to high fiscal vulnerability to high debt issues, and all these factors combined would lead to a slowdown in growth. The IMF has a forecast for about 3.7 to 3.8%. And if you consider the fact that due to the high energy cost of last year, we could see a possible slowdown in production. For Nigeria, we saw that the manufacturing sector entered into a recession in Q3 or Q3 2022, and that can actually spill over to across other major economies. Egypt, for instance, is being plagued by its huge exposure to Russia-Ukraine war. South Africa has its own internal issues. Kenya has its own debt issues. Ghana has its, of course, with the recent spike about Ghana's debt levels. And of course, Angola also has its own issues, even though it has been benefiting from the oil price surge.
Now, your report said if there was a slowdown in if there was a pivot, rather, in Fed rate hikes, that could possibly give a breathing room to central banks here. We just saw, of course, yesterday that the Federal Reserve hiked their rates by just 25 basis points. Folks are expecting 50 or higher. Does that mean that there is no breathing room then if the hikes continue for the Sub-Saharan region?
Well, we will say not yet, because as long as the inflation rate in the US is above the Fed's target, it will continue to raise interest rates. And that would not bode well for African currencies, African central banks. And that's because that would make debt more expensive, because, of course, the US yields are more of the reference rate when it comes to analyzing regional security. So if the US Fed keeps increasing interest rate, you're going to keep seeing a lot of pressure on African central banks to also keep raising their interest rates. And if we take a cue from the last MPC meeting, there's this silent, I would say, consensus that once the US Fed stops increasing interest rate, then we might probably see a lot of central banks in Africa begin to hold or even reduce their interest rate. But that we don't see that happening yet, because inflation is still above the US Fed's target, and we'll just keep monitoring to see if inflation can slow well enough for the US Fed to provide room for some accommodation. Okay,
so you've alluded to it. We still see rate hikes in Nigeria. We just saw it in Ghana. We also saw it in South Africa. So what's the trajectory then? Is then that you're saying that's now dependent on what happens on the developed side with the Fed, and we're going to get the Bank of England later today. We'll get the European Central Bank later today. So the rate trajectory for the Sub-Saharan Africa is dependent on the global side. Is that what you're saying?
Exactly. Very well.
Okay. We've got a chart here from your report looking at I have to ask you about this, the negative real returns for a number of these African nations. So I love this chart. You've put it against their interest rate adjustment. So I think you're subtracting year-on-year inflation from MPR, and you can see Ghana there is just okay. How do you attract investors with such a deficit?
So currently, in the current environment, right, because yields are rising in advanced economies, it will be difficult to attract investors, right? The only country we see now that may look somewhat attractive is probably Angola, and that's because it benefited from the high oil prices. We've seen inflation drop from as high as 27% at the beginning of the year, 2022, to as low as 13% at the end of the year. And that particular country has room to actually reduce interest rates. And of course, the Bank of Angola also has plans to reduce interest rates, given the favorable inflation outcome. So in this kind of environment, really, if the narrative favors your country, probably an underlying commodity that you have, for instance, oil, the reason why Nigeria is not benefiting is because subsidies are taking away are netting off the revenues from oil, the FX inflows from oil. So if countries that are oil producing can take advantage of that to produce more and earn more FX. Of course, investors will shine on those countries, and countries that adopt fiscal sustainability measures, they are going to actually give a green light to investors. But those investors will not come in until the US Fed probably stops increasing interest rates, so that they will not be caught off by any shock that could arise as a result of the continued uptick in the Fed's interest rate.
What about the currency performance? I think you've also got another chart for 2022 looking at, I think, year-to-date performances for a number of the African currencies. So is that also tied to, this is 2022, yes?
Yes, it is.
So I'm glad you benchmarked it against when the invasion began. So just like that, Ghana still, okay, so yeah, what are we looking at with currencies for the SSA?
So definitely for currencies, we still expect broad-based depreciation. If we look at the futures data, which suggests investors could decide today that I want to exchange this currency in future at this price. So when we looked at the futures data for 5 currencies, we discovered that for the Angolan Kwanza, investors expect it to weaken by about single digits, 6%. But from the Nigerian Naira to the Ghanaian Cedi and to the Kenyan shilling, it expects depreciation of about between 10 to 15%.
Wow.
And what that means is that investors are pricing in the possibility of continued Fed rate hike, continued high oil prices, which is not good for countries like Ghana and Kenya, which are net oil importers. For Nigeria, which is a net oil exporter, the issue of subsidies is actually a major headwind in the room, because when you make 500 billion, for instance, dollars from oil, and you pay off 500 billion in subsidies, the net effect is zero. So that's the reason why we think currencies will continue to depreciate across board. The only bright outlook is probably for Angola, which could see some consolidation at around it's 500 to 514, 500 Kwanza to the dollar level. So except for that currency, other currencies are expected to depreciate over the course of the year.
Almost out of time. Let's just, I think we round up with Nigeria. Elections next month, fuel scarcity, Naira note scarcity, just all of that in a big bag. What's the quick outlook for Nigeria as far as where we see things this year, or where you see things this year?
Okay, so for the elections, right, we even did some analysis in our report looking at the voter turnout ratio, and we discovered that the last time we had a high voter turnout ratio was in 2003. And that might repeat itself again this year, because you have 3 major candidates from the 3 major tribes in Nigeria. And looking at the NOI polls, which has a high predictability rate, you discover that the number of undecided and refused voters and refused respondents was actually very high, up to about 40 to 50%. So there's a lot of uncertainty as regards the election, but we think that the 3 leading contenders are actually pro-market, and whichever of them emerge as president of Nigeria, we think they will be willing to carry out those certain reforms. We see that for the 3 candidates, they actually support subsidy removal, which is positive for the economy. Once that subsidy removal happens, we could see some positive reactions from credit rating agencies, and we could actually unlock some funds with the IMF and the World Bank. So I think that trajectory is actually positive for the economy. And we think because we don't have so much dominant foreign investors within our system, that's why you don't see as much negative reaction. You see that the equity market is up year to date, and you're seeing the fixed income market also trade because of the high level of system liquidity. So you don't see it at prohibitive levels, considering the level of risk in Nigeria. So for inflation, we expect inflation to continue to rise. We estimate 22% as the average inflation rate for 2023, because we think subsidy removal will eventually happen. The recent guidance from the Minister of Finance is that from April through June, there's possibility that there will be a gradual removal of subsidy, which will give the incoming inflation a soft landing in that to implement that reform. So we think that will elevate inflation, although there will be some fiscal gains from that decision, which will open room for investments in the midstream sector and the downstream sector. And despite the short-term inflationary pain, it will lead to exchange rate appreciation, because we actually see room for an appreciation in the parallel market for the Naira. But although in the official window, we actually expect some depreciation, because of course, investors would want a market reflective rate, and we think that should be around 500 Naira to the dollar levels. And for the parallel market, once subsidy is removed, there's a high chance that there will be an appreciation in parallel market, because there will be more funds for the CBN to intervene in the required windows. So we think that's overall the outlook for Nigeria.
Okay, okay. I mean, we're all here. We'll see whether that subsidy is removed when the new administration comes in. Real quick, let me squeeze this in. South Africa, ESCOM, is that still the major headwind for the South African economy? What's your outlook there?
Yes, definitely. For South Africa, like major economies, right? When you have public enterprises taking over certain sectors of the economy, you find it slow, you find it hard to implement reforms. And this has dated back to 2007, about 15 years now, when South Africa has been battling with power cuts. It had about 200 days of power cuts last year. And you know what that means for businesses. South Africa, that is a major manufacturing hub across the world. And for example, you had issues around flood and everything. So we think the issues of power cuts is actually very significant when it comes to economic growth and development. And we think that if it continues, it will continue to slow down South Africa's growth rate. The outlook for South Africa is that it will grow between 1.7 to 1.9% in 2022 and remain at about 1.5% in 2023. And we think that unless that issue is resolved and except we see substantial reform, we may not, the problem may actually continue or persist. You need to see market reflective prices. You need to ensure investment, although the reason why it is in the state it is currently is because of years of neglect. And of course, I think if they can rectify that over the medium term, they should probably spur back to above average growth.
We'll see how things work out. Ibukun Omoyeni, thanks so much for sharing this report with us. Sub-Saharan Africa Economist with Vetiva Capital Management. Thank you so much for your time. See how things go this year.